You have money in a savings account right now, and your bank is stealing from you. Not with fees you can see, not with charges you agreed to, with something so quiet and so legal and so completely normalized that most people never notice it happening until they do the math and realize they have been robbed in slow motion for years. Here is the number that started this for me. I had $18,000 in a savings account at Chase. I had kept it there for 2 years. I was proud of that $18,000. It represented discipline and sacrifice and saying no to things and working extra hours and all the things you do when you are trying to build something real. And one evening, I was going through my statements and I added up every single interest payment Chase had sent me over those 2 years on that $18,000. The total was $3.24. $3.24 for 2 years, for $18,000 sitting in their bank. I stared at that number for longer than I want to admit, because while Chase was paying me $3.24, they were lending my money to other people at 7, 8, 9, 10% and keeping the difference. They were making approximately $2,700 per year on my $18,000 while giving me $1.62 annually in return. I was not their customer. I was their product. And the worst part is I had no idea because nobody told me and I never asked. My name is David, and today I am going to show you exactly how much money your savings account is stealing from you right now, why the bank built the system this way deliberately, and what I did in one afternoon that turned $1.62 a year in interest into over $700 a year on the same money with the same federal insurance and the same level of risk, which is zero. But first I need to show you how big this problem actually is, because $3.24 on $18,000 over 2 years sounds like a small irritation. The compounding version of this over a lifetime is something different entirely. The average American household keeps approximately $41,600 in liquid savings accounts, according to the Federal Reserve's 2023 survey of consumer finances. The average interest rate paid by traditional big bank savings accounts as of early 2026 is 0.01% annually. On $41,600 at 0.01%, that is $4.16 per year in interest. $4.16. Meanwhile, the best high-yield savings accounts available right now are paying between 4.0 and 4.6% APY. On that same $41,600 at 4.3% average, that is $1,788 per year. The gap between what the average American earns on their savings and what they could earn on that same savings without any additional risk is $1,784 per year. That is $1,784 sitting on the table every single year that most people simply do not pick up because nobody handed it to them directly, and they never went looking for it. Over 10 years, that gap, compounded at the difference in rates, is not $17,840. Because of compound interest, the actual difference between keeping $41,600 in a big bank account for 10 years versus a high-yield savings account for 10 years is approximately $21,400. $21,400. Not earned through investing, not through risk, not through any expertise or effort beyond opening one different account, just from choosing where to park the same money you were already saving. I want to introduce you to 3 people, all 30 years old, all have $20,000 in savings, all earn $4,500 a month, all equally disciplined savers who add $500 to savings every month without fail. The only difference is where they keep the money. Kevin keeps his savings at Bank of America in a standard savings account. The interest rate is 0.01%. Kevin adds $500 a month consistently. He feels good about his financial discipline. He tells people he has a savings account, and he contributes to it every month. Over 10 years, Kevin's account grows from $20,000 to $80,000 from his contributions alone. The interest Bank of America pays him over those 10 years on his growing balance is approximately $42. Kevin has contributed $60,000 of his own money and earned $42 from the bank. The bank has earned approximately $48,000 in interest by lending his money to other customers during those same 10 years. Kevin is unaware of any of this. Priya keeps her savings in a high-yield savings account at a separate online bank paying 4.3% APY. Same $20,000 starting balance, Same $500 monthly contribution. Same 10-year period. Same federal insurance. Same zero risk. Priya's account after 10 years has grown to approximately $101,400. Not $80,042 like Kevin's. $101,400. The difference is $21,358. Priya did not work harder than Kevin. She did not take more risk. She did not make better investment decisions. She opened a different account one afternoon and earned $21,358 more on the same money over the same period. Then there is Marcus. Marcus does what we talked about in the last video. He keeps his 3-month emergency fund in a high-yield savings account and takes the additional savings beyond that emergency fund and invests them in a simple index fund in a Roth IRA. Marcus's emergency fund of $15,000 earns approximately $645 per year in the HYSA. His additional $5,000 invested in the market at 7% average annual return over 10 years becomes approximately $9,800 from that initial amount alone, plus the $500 monthly contributions he routes to his Roth IRA, which grow to approximately $87,000 over 10 years. Marcus's total savings and investment picture after 10 years is approximately $112,000 compared to Kevin's $80,042. Marcus did not earn more than Kevin. He did not budget more carefully. He just understood where different money should live and put it there. Same starting amount, same discipline, same monthly contribution, same 10-year timeline. Kevin has $80,042. Priya has $101,400. Marcus has $112,000. The difference between Kevin and Priya is one afternoon spent opening an account. The difference between Kevin and Marcus is understanding that your emergency fund and your wealth building money are two different things that belong in two different places. Now let me explain exactly why the big banks pay 0.01% and why this is not an accident or an oversight, but a deliberate and extremely profitable business model that has been running for decades. Banks make money on the spread. The spread is the difference between the rate at which they borrow money and the rate at which they lend it. When you deposit money into a savings account, you are lending that money to the bank. The bank borrows it from you at 0.01% and lends it to mortgage customers at 7%, car loan customers at 8%, credit card customers at 21%. The wider the spread between what they pay you and what they charge their borrowers, the more money they make. Big banks like Chase, Bank of America, and Wells Fargo have something that smaller online banks do not have: enormous branch networks, massive marketing budgets, decades of brand recognition, and the psychological inertia of millions of customers who opened accounts when they were teenagers and never left. These banks do not need to offer competitive interest rates to retain customers, because most customers never check whether their rate is competitive. A 2024 survey by Bankrate found that 57% of Americans have never compared savings account interest rates across different institutions. 57% have never once looked at whether they could be earning more on their own money. The big banks know this. They price their savings accounts accordingly. High-yield savings accounts work differently because they operate differently. Online banks and certain credit unions have no physical branch network to maintain, no tellers, no real estate costs across thousands of locations, no ATM networks to run. Their cost structure is fundamentally lower, and they pass a portion of those savings to customers in the form of higher interest rates while still maintaining healthy profit margins. The money in a high-yield savings account is protected by the same FDIC federal insurance as the money in your Chase account, up to $250,000 per depositor per institution. The risk is identical. The return is dramatically different. As of early 2026, the best high-yield savings accounts are paying between 4.0 and 4.6% APY. The Federal Reserve has been managing rates in a range that has kept HYSA rates elevated relative to historical norms. These rates will change over time as the Fed adjusts monetary policy, but the spread between big bank rates and HYSA rates has historically been significant, regardless of the rate environment. When the Fed lowered rates to near zero between 2020 and 2022, Big bank savings accounts paid essentially nothing, and the best online accounts paid 0.4 to 0.6%, still dramatically more. The spread is structural, not cyclical. Here is something most people never think about, and it is the part that made me genuinely angry when I understood it fully. The Federal Reserve sets a benchmark interest rate called the federal funds rate. When the Fed raises this rate, banks immediately raise the rates they charge borrowers: mortgages, car loans, credit cards. The rate on your credit card goes up within weeks of a Fed rate increase. The rate on your savings account at a big bank goes up by approximately 0.001%, or not at all. Banks pass rate increases to borrowers almost instantly, and pass rate increases to savers almost never. This asymmetry is completely legal, completely deliberate, and completely invisible to most people, because most people are not watching it happen. A 2023 analysis by the Consumer Financial Protection Bureau found that the 10 largest U.S. banks increased their savings account rates by an average of 0.1% in response to the 5 percentage point increase in the federal funds rate between 2022 and 2023. In the same period, the average credit card rate at those same banks increased by 4.7 percentage points. The Fed raised rates by 5 points. Big banks charged you 4.7 more on debt and paid you 0.1 more on savings. This is not an accident. This is the business model working exactly as designed. Now I want to talk about the psychological trap that keeps most people in low-yield accounts even after they learn this information. Because here is what happens when people find out about high-yield savings accounts. They think about switching. They intend to switch, and then they do not switch. Research from the University of Chicago Booth School of Business on consumer financial inertia found that 71% of people who research better savings options and intend to move their money do not complete the transfer within 6 months. The intention to act and the actual action are separated by a gap that most people never close. The gap is created by friction and familiarity. Your existing account is set up. Your paycheck deposit's there. Your bills auto-pay from there. Your app is downloaded, and you know how to use it. Switching feels complicated, even though it actually is not. The research found that the average time required to open a high-yield savings account online and initiate the first transfer is 14 minutes. 14 minutes separates most people from earning $800 to $1,800 more per year on their existing savings. And 71% of people who know this never spend those 14 minutes. I was in that 71% for almost 2 years after I first heard about high-yield savings accounts. I heard about it. I looked it up briefly. I thought that seems like something I should do. And then I did not do it because my Chase account was fine, and I was busy, and it was not urgent. In those 2 years, I earned approximately $40 in interest on my savings. HYSA would have earned me approximately $1,400 in the same period. My procrastination cost me $1,360. Not through bad investing, not through bad decisions. Through 14 minutes, I kept not spending. The afternoon I finally did it, I timed myself. I opened a Marcus by Goldman Sachs account. I uploaded a photo of my ID. I entered my routing and account numbers to link my Chase account. I initiated a transfer. 14 minutes and 20 seconds start to finish. $1,360 per year in lost interest for 2 years divided by 14 minutes equals approximately $97 per minute I delayed. I have never made $97 a minute doing anything else in my life, and I never will. The only time I have come close was the 20 minutes I spent canceling subscriptions I talked about in the previous video. Here is what you actually need to know to take action today. High-yield savings accounts are available at several online institutions with strong reputations and full FDIC insurance. The consistently top-rated options as of early 2026 include Marcus by Goldman Sachs, Ally Bank, Sophie, American Express High Yield Savings, and Discover Online Savings. Rates change frequently, so checking a comparison site like Bankrate or NerdWallet for current rates takes about 3 minutes and ensures you are getting the best available option at the moment you open the account. The account opening process at every one of these institutions requires your name, address, social security number, and your existing bank account information to fund the initial deposit and set up transfers. You do not need to close your existing bank account. You do not need to change where your paycheck is deposited. You open the high yield account, transfer the money you want to earn better interest on, and keep your existing checking account exactly as it is for your day-to-day spending. The only thing that changes is where your savings live while they are not being used. There is one important structural decision to make when setting this up, and it will determine whether the account actually serves you the way it should. Your emergency fund and your savings goals are different things, and they should ideally be separated in a way that makes sense psychologically. Most high-yield savings accounts allow you to create sub-accounts or buckets within the main account. You label one bucket emergency fund. You put 3 to 6 months of living expenses there, and you do not touch it. You label another bucket car fund or house down payment or travel or whatever your specific savings goal is. The money in the goal buckets is what you are actively growing towards something. The money in the emergency bucket is insurance against the need to make a bad financial decision under pressure. The reason this separation matters is behavioral. When your emergency fund and your goal savings are in the same account, an emergency feels like permission to stop saving entirely. You use the emergency fund, the balance drops, and psychologically, it feels like you have gone backwards on your savings goal, even though that is exactly what the emergency fund was for. Separate buckets eliminate this confusion. The emergency bucket goes down. The goal bucket stays intact. You replenish the emergency bucket over the next few months. Nothing has been derailed. Here is something I did not understand for the first year I had a high-yield savings account, and it cost me meaningful returns during that period. High-yield savings accounts pay interest monthly and compound monthly. This means the interest you earn each month gets added to your principal and earns interest itself the following month. The compounding effect on a high-yield account is meaningfully faster than on a big bank account, not just because the rate is higher, but because monthly compounding accelerates the growth relative to annual compounding, which many big bank accounts use. On $20,000 at 4.3%, the difference between annual and monthly compounding over 10 years is approximately $1,200. The HYSA compounds monthly. The big bank compounds annually at 100th the rate. Every structural element of the comparison favors the HYSA. Let me give you the real long-term picture now. If you are 30 years old with $20,000 in savings, and you move that money to a high-yield savings account and continue adding $500 a month, here is what the next 35 years look like at the respective rates. At 0.01% in a big bank account over 35 years, your balance grows primarily from your contributions. You contribute $210,000 across those 35 years, and the bank pays you approximately $200 in total interest. Your balance at 65 is roughly $210,200. At 4.3% in a high-yield savings account, over 35 years, your $20,000 starting balance plus $500 monthly contributions grow to approximately $490,000. The interest the account generates is approximately $280,000 on top of your $210,000 in contributions. The difference between the two outcomes is $279,800. $279,000, not from investing in stocks, not from taking risk, from parking the same money in a different account with the same federal insurance. I understand that $490,000 in a savings account at age 65 is not a retirement plan on its own. The point is not that a HYSA replaces investing. The point is that the money you keep liquid for short and medium-term needs, your emergency fund, your house down payment savings, your car fund, your 6-month buffer, that money should be earning 4%, not 0.01% while it sits there. And for most Americans with $20,000 to $50,000 in liquid savings, the difference between those two rates over a decade is $15,000 to $50,000 in additional money that requires zero additional work, zero additional risk, and 14 minutes to set up. Warren Buffett has said that you do not need to do exceptional things to get exceptional results. You just need to avoid the unforced errors. Keeping $41,600 in a Chase savings account, earning 0.01%, when a federally insured alternative, paying 4.3%, is available online in 14 minutes, is one of the most expensive, unforced errors in personal finance. It is not dramatic. It is not a single bad decision you can point to and explain. It is just $1,784 that does not show up in your account every year and never triggers a single notification. Kevin ends up at 65 with $210,200 from 35 years of disciplined saving. Priya ends up at 65 with $490,000 from 35 years of the identical disciplined saving in a different account. Marcus ends up at 65 with significantly more because he used the HYSA for his liquid emergency fund and invested the rest. All three were equally disciplined. The difference was not effort or sacrifice or intelligence. It was 14 minutes and the knowledge that the question, can you get a better rate on the same money with the same insurance, has an answer, and the answer is yes. I had $18,000 sitting in a Chase account for 2 years earning $3.24 in interest. I was not stupid. I was just not paying attention to something nobody had ever asked me to pay attention to. The bank was hoping I never would. They were making approximately $2,700 a year on my $18,000 and paying me $1.62 annually for the privilege. That is not a partnership. That is not a service. That is a business model built on the assumption that you will never do the math. Do the math. Open the account. It takes 14 minutes. And every month after that, your money earns what it should have been earning the entire time while you were busy building it. My name is David. My savings account paid me $3.24 over 2 years on $18,000. I want better for you than that.